Welcome to our Global M&A Market Analysis, 2025 Retrospective and 2026 Strategic Outlook. The financial year 2025 will be permanently etched in economic history as a period of profound structural dichotomy. It was a year defined by the violent collision of two opposing forces, aggressive nationalist trade protectionism and an unyielding capital-rich appetite for corporate consolidation. Against a backdrop of the most significant restructuring of United States trade policy since the 1930s, precipitated by the Liberation Day executive orders, the global mergers and acquisitions market demonstrated a resilience that defied initial bearish consensus. Global M&A activity in 2025 staged a dramatic rebound, with total deal value surging to approximately $4.81 trillion, marking the second highest annual total on record and a robust 36% increase over the previous year. This resurgence was not a rising tide that lifted all boats, rather it followed a starkly K-shaped recovery trajectory. Well-capitalized strategic buyers and elite financial sponsors, insulated by strong balance sheets and access to investment-grade debt, drove a wave of transformative megadeals, those valued at over $10 billion. Conversely, the lower middle market struggled under the weight of sustained interest rates and the working capital shocks induced by the new tariff regime. The narrative of 2025 was dominated by defensive consolidation and the race for strategic assets. Corporations engaged in massive transactions not merely for growth, but to secure supply chains, energy assets, and the computational infrastructure required for artificial intelligence, AI. The headlines were commanded by historic transactions: the $82.7 billion acquisition of Warner Brothers, yet to close and subject to regulatory approval, the record-breaking $55 billion leveraged buyout of Electronic Arts by a consortium led by the Public Investment Fund and Silver Lake, and the creation of a new critical minerals giant through the Anglo-American and Tech Resources merger. However, this deal-making frenzy occurred within a radically altered macroeconomic framework. President Trump's declaration of Liberation Day on April 2, 2025, instituted a universal 10% tariff on all imports and reciprocal tariffs of up to 50% on select nations. This policy shock rewired global supply chains, forced an acceleration of reshoring-focused M&A, and introduced tariff exposure as a critical variable in valuation models. As the market transitions into 2026, the outlook remains cautiously optimistic, supported by stabilizing interest rates and a narrowing valuation gap between buyers and sellers. The pipeline for initial public offerings, IPOs, is rebuilding. Private equity, PE, firms are under immense pressure to deploy over $1.2 trillion in dry powder, and financing markets have shown remarkable depth. To fully comprehend the M&A activity of 2025, one must first analyze the macroeconomic and geopolitical environment that served as the crucible for deal-making. The year was characterized by a fundamental rupture in the post-Cold War free trade consensus, replaced by a new era of reciprocal trade, economic nationalism, and fiscal experimentation. On April 2, 2025, President Trump invoked the International Emergency Economic Powers Act, ICEPA, to declare a national emergency regarding the U.S. trade deficit. In a speech proclaimed as Liberation Day, the administration announced a sweeping overhaul of the U.S. tariff schedule, a move described by political observers as the most significant protectionist action in nearly a century. The policy was not a blunt instrument, but a multi-tiered mechanism designed to force reciprocity and revenue generation. A flat 10% tariff was imposed on virtually all imports from all countries. This effectively reset the cost basis for the entire U.S. import economy overnight, impacting everything from consumer electronics to industrial fasteners. 4 days later, specific country rates were adjusted to mathematically match the tariffs those nations imposed on US goods. This resulted in individualized rates ranging from 11% to 50% for 86 identified countries. The administration removed de minimis duty-free treatment for shipments under $800 from China and Hong Kong. This closed a logistics loophole favored by direct-to-consumer e-commerce giants and imposed significant compliance costs on the logistics sector. The immediate aftermath was a liquidity shock. Importers faced sudden spikes in working capital requirements to cover duties upon entry. Core personal consumption expenditures, PCE, inflation forecasts were revised upward to 3.1% due to the pass-through of these costs. For the M&A market, this necessitated an immediate repricing of risk. Synergy models based on global labor arbitrage were rendered obsolete, replaced by models prioritizing domestic supply chain security and pricing power. The economic backdrop of 2025 followed a stark K-shaped trajectory, a divergence that was mirrored precisely in the M&A market. The recovery was unequal, driven by asset ownership and pricing power. This segment comprised large, well-capitalized technology firms, energy majors, and investment-grade corporations. These entities benefited from the winner-takes-all dynamic of the AI supercycle and the energy transition. Flush with cash yielding 5% and capable of accessing bond markets at tight spreads, these companies drove the surge in mega deals. They utilized M&A to secure growth in a low-growth macro environment, buying innovation and infrastructure rather than building it. The lower arm was populated by smaller enterprises, lower middle-market companies, and consumers without asset wealth. These groups faced a triple threat. To combat tariff-induced inflation, the Federal Reserve maintained restrictive rates longer than anticipated. Small manufacturers lacked the pricing power to pass on the 10 to 50% tariff costs, leading to margin compression. While luxury spending remained robust, mass market consumption softened, creating distress in the retail and consumer discretionary sectors. This bifurcation acted as a catalyst for consolidation. Distressed smaller players became attractive targets for larger, capitalized buyers, leading to a wave of take-under acquisitions and roll-ups in the industrial and consumer sectors. The Liberation Day policies triggered immediate retaliation. China imposed export controls on critical minerals and tariffs on US agricultural products, while the European Union debated a complex mix of countermeasures. For M&A practitioners, this solidified the trend of friend-shoring. Deal flow shifted noticeably away from hostile jurisdictions. Cross-border activity between the US and friendly nations like Canada, the UK, and Japan remained robust, as evidenced by the regulatory approval of the Nippon Steel acquisition of US Steel and the Anglo-Tech merger. However, these deals required explicit national benefit packages. The era of frictionless cross-border capital was replaced by an era of negotiated access, where foreign investment was welcome only if it aligned with US industrial security interests. To fully comprehend the M&A activity of 2025, one must first analyze the macroeconomic and geopolitical environment that served as the crucible for deal-making. The year was characterized by a fundamental rupture in the post-Cold War free trade consensus, replaced by a new era of reciprocal trade, economic nationalism, and fiscal experimentation. Global deal value for 2025 is estimated to have reached $4.81 trillion, a dramatic 36% increase over the previous year. This figure represents the second highest annual total on record, eclipsed only by the liquidity-fueled boom of 2021. However, deal volume, the total number of transactions, increased by a more modest 5%, reflecting a trend toward larger, more transformative transactions rather than high-volume, small-cap activity. The resurgence was heavily weighted toward the second half of the year. The first quarter was dampened by the immediate uncertainty surrounding the US inauguration and the subsequent Liberation Day announcement. As corporations adjusted to the new tariff reality and financing markets reopened in Q3 and Q4, activity exploded. October 2025 set a new monthly high for deal value, driven by easing financing costs and narrowing valuation gaps. The defining characteristic of 2025 was the prevalence of mega deals, transactions valued over 10 billion. There were a record 70 mega deals announced or closed in 2025. This concentration of capital at the top end of the market underscores the strategic imperatives of the year. Companies sought scale to absorb regulatory compliance costs and tariff impacts. Tech giants utilized M&A to secure the energy and hardware infrastructure required for AI models. After years of dormancy, PE firms utilized consortium structures to take private massive targets, example Electronic Arts, utilizing sovereign wealth capital to bridge equity gaps. The North America region remained the undisputed engine of global M&A, accounting for 55% of global deal value. The US market served as a safe haven for capital flight from more volatile regions and was the epicenter of the AI and media consolidation waves. Europe contributed 22% of global value. Despite the looming threat of a trade war with the US, European activity was surprisingly resilient, up by 11% year over year. Key drivers included industrial consolidation in Germany and defense-related M&A as the continent ramped up military capabilities. APAC contributed 21% of global value. Japan was a standout performer, with governance reforms driving domestic consolidation and aggressive outbound investment, example Nippon Steel. China's outbound activity remained subdued due to geopolitical barriers, but internal consolidation in the state-owned enterprise sector continued. The following transactions define the narrative of 2025. They were not merely financial exchanges, but strategic pivots that reshaped entire industries, establishing precedents for valuation, structure, and regulatory navigation. The media landscape of 2025 was dominated by the endgame of the streaming wars. On December 5, 2025, Netflix and Warner Bros. Discovery (WBD) announced a definitive agreement for Netflix to acquire WBD Studios, HBO, and HBO Max assets. Crucially, this deal was structured to separate the high-growth assets from the secularly declining ones. The transaction involves the prior separation of WBD's global linear networks business, Discovery Channel, CNN, TNT, into a standalone entity. Netflix is acquiring the Good Co., Warner Bros. Studios, DC Comics, Harry Potter IP, HBO, leaving the debt-laden linear assets behind. This aligns with Netflix's strategy to own the world's most valuable IP library without being burdened by the decaying cable TV model. On December 8, 2025, Paramount Global launched a hostile all-cash tender offer valued at $108.4 billion for the entire WBD company. On December 17, 2025, the Warner Bros. Board unanimously recommended shareholders reject the Paramount offer. The board characterized the Paramount bid as illusory and inadequate, citing significant financing risks and the lack of a promised full backstop from the Ellison family, Paramount's controlling shareholders. The board viewed the Netflix stock component as offering superior long-term value compared to Paramount's debt-heavy cash offer, despite the lower headline price. If closed, this merger creates the undisputed hegemon of global entertainment. It combines Netflix's distribution algorithm with HBO's prestige content and Warner Brothers' century-old IP vault. It signals the final capitulation of the fragmented streaming model, moving the industry toward a monopoly and duopoly structure. In the largest leveraged buyout, LBO, in history, surpassing the 2007 TXU Energy deal, Electronic Arts agreed to go private. This deal highlights the massive appetite of sovereign wealth funds, SWFs, and the convergence of gaming, technology, and geopolitics. Key drivers. The purchase price of $210 per share represented a 25% premium to the unaffected share price. The deal includes $20 billion in committed debt financing, approximately 6 times leverage, led by JP Morgan. This proved that despite high rates, debt markets are open for high-quality, cash-generative deals. The inclusion of the Public Investment Fund, PIF, rolling over its stake, alongside Silver Lake, tech expertise, and affinity partners suggests a long-term play to anchor the global gaming industry in both Silicon Valley and Riyadh. Going private allows EA to transition its business model, likely investing heavily in AI-driven game development and metaverse platforms, without the quarterly scrutiny of public markets. It also frees the company from the hit-driven volatility of release cycles. This merger of equals created Anglo Tech, a new global critical minerals champion headquartered in Vancouver. Why it matters. The deal is a bet on the electrification of the global economy. Copper demand is projected to soar due to EV production, grid modernization, and AI data centers, which are copper-intensive. The combined entity possesses a world-class copper growth portfolio. The approval under the Investment Canada Act required stringent binding commitments. The global headquarters must remain in Canada, senior management must reside there, and significant R&D spend, $4.5 billion, is locked into Canadian projects. This reflects the 2025 trend where M&A in critical sectors requires explicit national benefit packages to pass regulatory muster. After a contentious political battle that spanned the 2024 election, President Trump issued an executive order on June 13, 2025, allowing the deal to proceed subject to a National Security Agreement, NSA. The compromise. The deal, initially blocked by the Biden administration, was salvaged through a unique structure designed to preserve U.S. sovereignty over critical infrastructure. The U.S. government holds a golden share, allowing it to block board decisions regarding production capacity and national security supply chains. Nippon committed to $11 billion in new investments in U.S. steel facilities by 2028. This deal serves as the blueprint for cross-border M&A in 2026. Foreign capital is welcome, but operational control of strategic assets remains tethered to U.S. national security interests. Sector-specific analysis, the drivers of consolidation. Technology M&A in 2025 was defined by the infrastructure layer of artificial intelligence. With software valuations still correcting, capital chased the picks and shovels of the AI gold rush. Google's $32 billion acquisition of cybersecurity unicorn Wiz underscores the desperate need to secure the cloud environments where AI models reside. We saw significant vertical SaaS consolidation, such as the acquisition of Squarespace by Permira for $6.9 billion and the Synopsys-Ansys merger, aimed at creating integrated design platforms for chip manufacturing. Amazon, Microsoft, and Google continued to acquire power generation and fiber assets to feed their data centers, effectively becoming utility operators. Energy M&A operated on two distinct but parallel tracks. ConocoPhillips acquired Marathon Oil for $22.5 billion. This represents defensive consolidation to drive efficiencies in a mature market, ensuring free cash flow for dividends and buybacks. The rush for copper, Anglo-Teck, and lithium intensified. However, the Liberation Day tariffs on batteries and solar components from China spurred investment in domestic manufacturing assets, driving M&A in the US battery supply chain. The tariff regime forced industrials to buy their way into the US market. The $42 billion buyout offer for Toyota Industries reflects the consolidation of the automotive supply chain as EVs disrupt traditional parts suppliers. The dismantling of traditional industrial conglomerates continued. Honeywell announced the separation of its automation and aerospace businesses into standalone public companies while acquiring Sundyne for $2.16 billion to bolster its energy processing capabilities. Carrier Global completed its portfolio transformation by selling its commercial and residential fire business for $3 billion and divesting its Riello combustion business to Ariston Group. The pharmaceutical sector continued to be driven by the patent cliff and the search for the next blockbuster, with a specific focus on the metabolic revolution. Companies sought to acquire assets that complement the GLP-1 obesity drug revolution or hedge against it. Pfizer's acquisition of weight loss drug developer Metsera for $4.9 billion is a prime example of big pharma buying its way into this lucrative vertical. PwC noted a rebound in health services deals, with private equity looking to deploy capital into provider roll-ups that had been paused in 2024, focusing on high-quality assets with clear reimbursement visibility. Private equity firms entered 2025 with unprecedented levels of dry powder. Estimates range from $1.2 trillion to over $2 trillion, depending on the metric. However, this capital has a shelf life, and general partners GPs faced immense pressure from limited partners, LPs, to deploy. This pressure drove the massive equity check for the EA buyout. It also fueled a surge in sponsor-to-sponsor trades, one PE firm selling a portfolio company to another, as IPO markets remained selective. To synthesize the forces shaping the market, 6 key drivers emerged in 2025. The Liberation Day tariffs made global supply chains a liability. Acquiring domestic capacity became faster and cheaper than building it, driving industrial M&A. AI moved from a software story to a hardware energy story. M&A became the primary tool for securing the physical assets, chips, data centers, power needed to compete. Debt markets reopened. The successful syndication of the $20 billion EA debt package proved that banks were risk-on for the right assets. Funds like PIF became the equity of last resort for megadeals, filling the gaps left by cautious public shareholders. Antitrust enforcement shifted from consumer welfare to national security. Deals were blocked not just for price effects but for geopolitical implications. Examples: CFI-US scrutiny. The gap between the haves, tech, energy, pharma, and have-nots, retail, manufacturing, widened, driving consolidation as the strong acquired the weak. As we enter 2026, the global M&A market is poised for what Goldman Sachs and Bain & Co. describe as a great rebound. However, the path forward is contingent on the interplay of trade policy and inflation. We may consider one of 3 scenarios playing out in 2026. Tariffs normalize into a predictable cost of doing business. The Federal Reserve cuts rates by 50-75 basis points as inflation stabilizes. Deal volume grows 15-20%. The IPO window is thrown wide open, allowing a massive wave of PE exits. Mega deals continue in tech and energy. Corporate confidence returns as the Liberation Day shock fades and businesses adapt. Retaliatory tariffs from China and the EU escalate. Inflation respikes to 4% plus, forcing the US Federal Reserve to hike rates. Deal activity freezes. Cross-border M&A collapses. Distressed M&A and bankruptcies spike in the consumer industrial sectors. Policy error leads to stagflation. The US administration aggressively deregulates antitrust and energy sectors, removing barriers to consolidation via M&A. A massive wave of consolidation in banking, telecom, and oil and gas. M&A volume exceeds 2021 levels. Animal spirits are unleashed by regulatory rollback. Dealmakers must monitor the following indicators in the first quarter of 2026. Will other countries adopt the US Nippon Steel model for protecting national champions? Will the EU AI Act slow down tech M&A in Europe relative to the US? Will PIF and other sovereign wealth funds face increased CFI US scrutiny as they expand into technology? Any widening in high yield spreads beyond 400 bps could signal the end of the leverage cycle. For corporate buyers, the window for transformational M&A is open. Use high stock valuations for those in the upper arm of the K to buy growth. Prioritize supply chain resilience and tariff-proof targets over pure efficiency plays. For private equity, the exit backlog must be cleared. Look to the public markets, IPOs, in the first half of 2026. If the IPO window shuts, expect aggressive sponsor-to-sponsor selling to return capital to LPs. For sellers, valuation gaps have narrowed. If you possess a high-quality asset in a protected sector, defense, healthcare, domestic energy, now is the optimal time to sell. In conclusion, 2025 was the year the M&A market learned to navigate a new world order. It proved that strategic necessity, the need to own AI, secure copper, and control IP, trumps macroeconomic uncertainty. As 2026 is now upon us, the boardrooms of the world have accepted that volatility is not a weather event to wait out, but a climate to operate within. Stay informed and proactive. Leverage insights from 2025 to drive strategic decisions in 2026. Let's shape the future of M&A together.